lot of the policies that the administration has pursued have been geared to helping to address that problem. The whole business of reshoring production and creating a revitalized manufacturing sector here, and the no tax on tips. And a lot of this is really geared toward boosting blue collar jobs and trying to sort of narrow this yawning gap between the high end and the low end. But I think the thing that I worry about the most, since we're keep coming back to it, is the evisceration of inflation. And it's going to be invisible. It's not going to be like the Biden inflation where everyone saw it, in the grocery store. Mm-hmm. It's going to be silent but deadly via debased dollar purchasing power. And so the people at the top of the eye who have already a lot of wealth amassed might find that in real terms, they're flat or even lower, but it's not going to materially affect their lifestyles. Whereas the people on the lower end, it's really going to be a struggle in terms of amassing enough for retirement. I mean, how do you do that? That's going to be incredibly challenging. So that's what I worry about. But I do think the administration has tried to implement some policies to help boost Main Street. I mean, the ultimate way to fix that problem is to have a 2008 repeat. And what happens there is the high-end net worth gets destroyed. And so you can narrow the gap by the high-end having their equity portfolios and their real estate portfolios, cut in half, which obviously doesn't really help anyone. It ends up hurting the low end as well because employment gets stocked, their 401ks get stocked. So it's bad for everyone, but it would, narrow that gap a little bit. But then, the response to that, of course, would be another massive bailout with more money printing that we start the cycle all over again. Right. There's no political will for that whatsoever. You're talking about like a Great Depression style scenario. The only other alternative would be to revalue the currency, to have a hard money currency such that there are constraints to debasing the dollar and printing money and bailing out people ad nauseam, which got us to this $37 trillion in debt in the first place. I think it will be far sooner than most people imagine. I mean, most people don't imagine we'll have a new monetary regime, but I think that we're at the point, and it's not just the U.S., and this is why. It's, Japan, the U.K., Germany, all of the major industrial economies are in the same situation we are, with aging populations and completely untenable obligations to those aging populations, be it Social Security and welfare and all this stuff that they've financed with loads of debt. So at some point, everybody's going to have to enlist the central bank balance sheet to absorb all, to print the money to pay for it. And I think there's a point at which you end up having to go back to a hard money alternative. And I do think it comes sooner than later, just because we're all at this kind of, look at Japan, it's sort of the perfect microcosm. We're all at this point where I'm old enough now for the original Star Trek, when Captain Kirk would keep saying, like, make me go faster or whatever. And he said, I can't give her anymore. I mean, we're kind of at that point, right? It's a massive money market fund, basically, that's going to sop up T-bill issuance. And in that regard, the desire to push this Genius Act really underscores the fact that we, again, are in this box. I mean, Scott Bessent on the campaign trail, or while he was, trying to get the job as Treasury Secretary, was out there deriding Janet Yellen for issuing all the debt at the front end of the yield curve, servicing our massive deficits with T-bills. And here he is, and he finds that's his only option now. He doesn't really have a choice. And that's why they urgently needed this stablecoin reserve, so that they can create a source of ongoing demand for T-bills, and then they can continue to just finance at the front end. And they did that alongside this proposed tweak to the supplemental leverage ratio for banks, which the idea there is to free up more capacity of the U.S. banks to buy treasuries, which I find kind of laughable because they're already sitting on almost $500 billion of unrealized losses on treasuries. So basically the government's now saying, hey, we're going to give you an opportunity to buy even more of this paper that you're losing money on. I mean, I don't know what the appetite for that is, to say nothing of the idea that thought the whole goal was to re-privatize the economy, and now you're encouraging the banks to lend to the government rather than the private sector. So, these are all, when I look at it, seem like desperate measures being undertaken by people who are smart and understand the situation and are not inclined to take these steps, but are being forced to do so because there are just no other options. And we're at the point where this is the only roadmap we can go down. So I view it, eventually they're going to have to re-expand the balance sheet. You're not going to drum up enough demand for treasuries from banks who are already losing money hand over fist on the ones they own, and from the stablecoin reserve, which I think the total market cap of stablecoins right now is 200 or 300 billion. So even if that grows to $1 trillion tomorrow, it's something, but it's not enough. When I had the idea, I guess it's a year ago, that what they should do is make treasuries tax-free, and that way create domestic demand for treasuries to replace the exiting foreigners. But I would argue, the measures that they're taking now are 5 times more gimmicky than making treasuries tax-free. That might actually create some real sustainable, durable demand, whereas the SLR and maybe the stablecoin thing will grow into some enormous money market trove, basically. I'm not persuaded, but we'll see. But the SLR thing seems like really just pissing in the wind. I think the total capital gains receipts for all capital gains was like $200 billion a year. So the share of that's treasuries. Even if you assume half of it, which is nothing close to that. So let's say it's 100 billion. Obviously, at 37 trillion, every 1 percentage point decline is $370 billion in interest savings.
Okay, yeah.
So there's no comparison. It's probably 5 times the benefit to the cost. That's not the issue. I guess it's maybe disenfranchising state and local governments who right now have the complete deductibility, tax-free status, and sort of maybe creating problems for state and local governments by providing competition for tax-free status with the federal government.
Okay.
But I view this national security aspects of preserving our deficit financing as far more important than state and local government revenue situation. For a long time, my real operating thesis, I'm trying to think of a way to articulate this so that everyone can understand. I've been a devout worshiper at the altar of reflexivity, and that is this idea that interest rates or anything will rise to the point that it sows the seeds of its own decline, especially true with, currencies and interest rates. George Soros happened to be one of the first people to kind of pursue this notion. And my feeling, talking in the context of these Fed rate cuts not really having efficacy as the long end refuses to come down, is that will happen to a point that it creates a correction either in the stock market or a recession in the economy or both, at which point you'll probably get that reflexive decline in the long end. However, the caveat would be that I expect that decline to be far less dramatic and to last for a far shorter period of time, because it will only take the average investor about 37 seconds to figure out that an economic downturn is going to lead to larger deficits, which is going to continue to put upward pressure on the long end of the yield curve. So if you blink, you might miss the rally. I think there will be one. I don't think it'll be super dramatic, but I'm sure you will at some point get an opportunity to sell. Probably not at the kind of levels you would like to, but that's my 2 cents on it for whatever that's worth. Probably ain't much. Just the idea that we're going to start to, expand nuclear in general. And that's the whole case for uranium. We have sort of an everything is on the table approach to energy policy here in the United States. So I think that's very bullish for nuclear as well. Yeah, no, it's another very interesting area. And as you said, this whole AI thing, that's what's really interesting to me. I am terrified by AI itself a little bit, given my technophobia, but the energy consumption aspect of it is something that I don't know is getting enough attention, especially when you think about it on top of the energy consumption of the crypto mining, Bitcoin mining and all of that, which also consumes a massive amount of energy. So we've got all these great new revolutionary technologies, but at the end of the day, it all comes back to the basic resources upon which all of these things depend. And those basic resources are so grossly underpriced relative to paper assets. I mean, if you just look at the stock market relative to the CRB index, for example, a broad commodity index, it's like that miners chart used to be relative to gold. I mean, it's just so low and it's hitting, multi-decade lows. And so this is something that, people like me have been real advocates of, this idea that we're undertaking a secular shift away from paper assets to hard assets. And right now, like AI and these NVIDIA stocks and all of this going bananas without a like enthusiasm for the energy producers that will be required to support it. And I think from an investment standpoint, this is an area where there's so much opportunity. And so bringing the next 10% out of NVIDIA, and I don't mean to just single that out all the time, but these Mag 7 companies that have run so far so fast is far less compelling to me than buying these super cheap resource producing companies, because that, as we've been saying, is going to be a long-term play that should reap tremendous rewards over the next, several decades.